You drop any more, and we're going to trigger the banks. Now, that's where I think the Fed will do an emergency rate cut. And that is not good for the stock market. If you go back to the 2000 top or the 2007 top, when the Fed started cutting rates, that was a sign they knew something was wrong. So I think we're at that cusp right.
You're watching Silver News Daily. Subscribe for more.
Did you know the FED next move could skyrocket silver prices overnight? Imagine waking up to a world where silver prices have doubled or even tripled, all because of a single decision by the Federal Reserve. In today's video, we're diving into why experts believe an emergency rate cut is just around the corner and how it could trigger the biggest silver boom we've seen in years. This is news you can't afford to ignore, especially if you're a silver stacker. Stick around because by the end of this video, you'll know exactly why this could be the most important financial move of 2024 and how you can prepare before it's too late.
Year. The problem now is the market can't take it. The broad stock market. Back then, the stock market had already had a major decline in 2022 and was trying to turn up. So when the banks had that drop in March, April, and May of last year, it caused the S&P to pull back a little bit. It didn't make a new low, but it was already had been punished. The S&P had. This time around, the S&P has only just now become vulnerable. And so if you kick the KBE through its structures, and they're literally a few percent below the low we saw this week, if you trade those levels, like we traded down to 47 on that ETF, you get down to 46 or much lower, and it's going to start. And I argue that if that starts, it looks like a something that could be fairly rapid, headline-y type stuff. That is a sector of the stock market the Fed will not dismiss. I don't think they care about NVIDIA, but they care about those banks. And if you look at what happened last week on a percentage basis to that ETF and also to the major name banks, the percentage drop they suffered last week and are not really recouping from this week was far more than the S&P suffered. And yet that wasn't a headline. You drop any more, and we're going to trigger the banks. Now, that's where I think the Fed will do an emergency rate cut. And that is not good for the stock market. If you go back to the 2000 top or the 2007 top, when the Fed started cutting rates, that was a sign they knew something was wrong. So I think we're at that cusp right. I definitely. The key is the bank index, the bank sector. And we think technically is very vulnerable to something dramatic. And I don't think it's going to be delayed too long. Why? Because the banks had a huge up month last month. And when you look at the price charts, it impressed a lot of people. Now, they didn't go back to their 2022 highs like the S&P and other indexes were, but they shot up, halfway back up there. They looked really good in July. They erased that entirely in the first days of August. The entire big, huge up month was gone. And so it's moving pretty quickly. And the structures we see were approached so closely. And when I say structures or momentum, I mean, if it were a price chart and you saw what we see on momentum, you'd say, oops, this is going to break down. Okay.
When it comes to the world of precious metals, silver and gold often dance to the tune of interest rates. You see, in a typical economic environment, when interest rates go up, non-yielding assets like silver tend to lose their luster. Investors shift their focus to assets that offer better returns, like bonds or savings accounts. But here's where it gets interesting. When the FED starts cutting rates, the game changes entirely. Silver, much like gold, thrives in an environment of low interest rates. Why? Because rate cuts generally lead to a weaker U.S. dollar, and when the dollar drops, silver prices tend to rise. Historically, we've seen silver prices surge during periods of economic uncertainty, especially when the FED steps in with rate cuts to stave off a potential recession. It's during these times that investors flock to silver as a safe haven, seeking to preserve their wealth in an asset that's not tied to the ebb and flow of interest rates. But this relationship isn't just about rates dropping and silver prices rising. It's also about the broader context, market sentiment, inflation expectations, and global economic stability all play significant roles. When investors sense that the economy is teetering on the edge, or that inflation might spiral out of control, they often turn to silver as a hedge. This is exactly the kind of scenario we could be heading into now, with the FED likely considering a rate cut amidst a shaky economic backdrop. And remember, it's not just about what's happening in the U.S. Global dynamics, like how other central banks are managing their own interest rates and economic policies, also feed into the silver story. If the FED cuts rates and the dollar weakens, silver becomes more attractive not just to American investors, but globally. So, as we anticipate what might come next from the FED, it's crucial to understand that silver's potential to surge is not just a fluke. It's a well-documented pattern that plays out when rates drop, the dollar weakens, and market uncertainty grows. And right now, all signs are pointing to the possibility that we're on the brink of such a scenario.
Where he stressed that staying too high too long could do damage, even without waiting for the data to prove that it did damage, that it could do damage. And yet he hasn't cut. What's he trying to do? Play a game? And a lot of people are wondering, why not? The job data has not looked good. And not only not looked good recently, but even when you look back at the prior job reports months ago, they were getting worse and worse in terms of, long-term jobs, not the short-term, et cetera. And they've ignored that. And now this Japanese event hit where Nikkei crashed. We have a yen crisis. The yen has rebounded, but it's caused a problem with the yen carry trade thing where a lot of people had positions based on, all that stuff. And a lot of that's unwound, no doubt, recently due to the recent sharp drop in the stock market and the panic. And I suspect this week we're going to hover around in the stock market and cool things off for a few days. Next week, probably resume. There is one variable out there that I know will kick the Fed in the gut, and that's the banks. We went through this back in January of 2023, the KBE, which is what we watch, the primary one, it's the ETF of the larger banks. January 2023 late, we warned there looked like a crash situation setting up for the banks. Technically speaking, we had no knowledge of any specific banks, And then the stories came out about regional banks and all that, but they did crash. And in fact, in early March, they hit our trigger number. And within about 5 or 6 weeks, they dropped 34%. That's a crash dimension, that percent. It was a little slower than a crash, but still, it was a crash-like drop. The Fed didn't cut them because they were already in the process of raising rates, so they couldn't abruptly stop. But they've now said, okay, we're through raising rates, and they're looking for a reason to cut. And I'm telling you right now that momentum analysis of the KBE is almost precisely the way it looked prior to that March debacle, March, April, May of last.
Let's take a closer look at the current economic landscape, because it's this backdrop that could push the FED to make a pivotal decision. And it's one that could send silver prices soaring. First up, let's talk about the labor market. The latest jobs report came in weaker than expected. The U.S. economy added only 114,000 jobs in July, significantly lower than what was anticipated. More importantly, the unemployment rate ticked up to 4.3%, which might not sound alarming at first, but it's enough to trigger the Sahm Rule recession indicator, a measure with a perfect track record in predicting economic downturns. When unemployment rises by 0.5% from its lowest point in the past year, it's a red flag that the economy is in trouble, and we've just hit that mark. But that's not all. Inflation, while somewhat under control, is still far from the FED comfort zone. Despite their aggressive rate hikes over the past year, the underlying economic weaknesses are becoming more apparent. The Consumer Price Index, CPI, data shows inflation cooling off slightly, but it's still persistently high, putting pressure on consumer spending and overall economic growth. This kind of mixed signal environment, where inflation is stubborn but growth is stalling, puts the FED in a tight spot. Additionally, there's been a notable slowdown in GDP growth. The economy isn't expanding as it should, and this sluggishness is another indicator that a rate cut might be necessary to prevent a full-blown recession. Add to this the recent turbulence in global markets, such as the unexpected rate hike by the Bank of Japan, which spooked investors worldwide, and you have a recipe for uncertainty. All of these factors contribute to a growing sentiment that the FED needs to act, and act soon. Market watchers are increasingly betting on a rate cut as early as September, and this anticipation is already stirring the silver market. The FedWatch tool, the popular gauge of market expectations for Federal Reserve policy, has shown a significant jump in the probability of a rate cut in the coming months. What does this mean for silver? Well, if the FED does cut rates, especially in an emergency move, it's likely to weaken the dollar further and boost demand for silver as investors seek safer, inflation-resistant assets. The market is already reacting to these indicators, and savvy investors are positioning themselves in anticipation of a silver rally. As these economic indicators continue to evolve, the likelihood of a FED rate cut becomes more pronounced, setting the stage for what could be a significant surge in silver prices. The question now is not just if, but when the FED will pull the trigger and how high silver could go once they do.
I'm not going to express an opinion on either side, okay? But my assessment is this: that is a factor that is not in the markets. Everybody knows that the country is divided, et cetera, and it's maybe different this time, but nobody senses that there's no outcome to this election, no matter which side wins, that's going to be copacetic. In other words, it's going to be uncopacetic. Now, I'm going to give you a hint. Now, this is not me talking. This is University of Virginia. I may have read these before on one of your interviews, but I want to do it again. Back in October of last year, they had a poll at the University of Virginia Center for Politics. They polled both Biden support Democrats and Republicans, likely Trump supporters. They asked some very interesting questions. And here's one of them, and I'm quoting them directly. Roughly half, 52% of Biden voters and 47% of Trump voters, again, this is like 9, 10 months ago, viewed that those who supported the other party were threats to the American way of life. Huge percent. About 40% of both groups, 41% of the Biden, 38% of the Trump voters, at least somewhat believe that the other side had become so extreme that it is acceptable to use violence to prevent them from achieving their goals. Okay, now if you think things have cooled down since then, we know that isn't true. And I suspect, therefore, if the University of Virginia did this poll again, they'd find the numbers are even higher. Propensity toward acceptability of violence. Well, again, is this priced into the stock market's view of future reality? Are we about to see 54 card pickup? The tablecloth yanked off the table, everything shattered. And we don't quite know what's on the other side, but it isn't orderly. Is that priced into the market? I don't think so. It's just something to ponder on. Again, that's the numbers from University of Virginia Department of Politics poll.
Now, let's dive into the dilemma that the FED is currently facing, a predicament that could have massive implications for the silver market. On one hand, the Federal Reserve is under immense pressure to keep inflation under control. On the other hand, the recent economic data, including the weak job numbers and slowing GDP growth, suggests that the economy is losing steam faster than anticipated. This brings us to a critical question. How can the FED balance these conflicting forces without tipping the economy into a recession? Michael Oliver, a respected analyst from Momentum Structural Analysis, has been vocal about this exact dilemma. According to Oliver, the FED current stance of maintaining high interest rates for an extended period is akin to walking a tightrope. The longer they hold rates high, the greater the risk of causing severe economic damage, potentially pushing the economy into a deeper downturn. Oliver highlights that the FED reluctance to cut rates thus far has been partly due to their fear of appearing panicked. He argues that an emergency rate cut could send a signal to the markets that the FED knows something is seriously wrong, much like what happened before the major market downturns in 2000 and 2007. This could trigger a crisis of confidence, not just in the stock market, but across the broader economy. Yet the FED is also acutely aware that failing to act in time could lead to even more significant problems. As Oliver points out, the banking sector is particularly vulnerable right now. The recent sharp declines in bank stocks, reminiscent of early 2023, have raised alarms. If the banking sector shows further signs of distress, it might force the FED hand. Oliver believes that if the banking index, KBE, drops significantly, the FED may have no choice but to implement an emergency rate cut to stabilize the situation. What does this mean for silver? Oliver's analysis suggests that if the FED is pushed into cutting rates under these circumstances, it could be a major catalyst for silver prices to spike. In his view, the silver market is already positioned for a rally, having built up momentum over the past several months. He compares the current setup to the silver market of 2010-2011, where after a period of consolidation, silver prices shot up dramatically. Oliver believes we could be on the verge of a similar acceleration phase, particularly if the FED steps in with a rate cut. The FED dilemma is clear: act too soon, and it risks signaling panic. Wait too long, and they might be forced into action by deteriorating economic conditions, particularly in the banking sector. For silver stackers, this is a pivotal moment. The decision the FED makes in the coming weeks could be the trigger that propels silver prices into a significant bull run. As Michael Oliver aptly puts it, monetary metals, including silver, are now in a position where they could move opposite to the broader stock market trends. This means that while the stock market may falter under the weight of economic uncertainty, silver could thrive as investors seek out safe havens. In this delicate balancing act, every economic indicator and market movement brings the FED closer to a decision point. And when that decision comes, the silver market is likely to react swiftly and sharply, potentially leading to the kind of explosive price movement that Oliver has been forecasting.
At that point onward, both metals went into a congestion type process where they were both up and down. In gold's case, it's more or less lateral. If you scroll down to the silver chart, you'll see that its peak in April, peak weekly close that is, was vastly surpassed in May. While gold basically stayed contained below its May peak, silver shot well above it. Silver is what we call a wild dog. And if you're in silver, you have to realize it's a wild dog. In other words, it's got a leash and it's attached to gold, but it's both much stronger than and often seemingly much weaker than. And of course, it was much stronger in that May surge where silver went 10% higher than it had been in April, whereas gold basically stalled at its April high. Now, you can see that the current action, this is through this week, down under 27 even, is below where the April peak weekly close was. We lived above it for a while, now we're below it, okay? Now, scroll up to the gold chart, and you'll see that it's basically at it. So gold's really more sleepy, but it's steady. Now, by the way, last week's close on gold, that was the new high weekly close. And right now, trading where we are at the moment, we're down about 3% below the peak weekly close of history. And yet people think, oh, gold and silver collapsing. Okay, silver is, seemingly. Gold is yawning, okay, despite the stock market debacle. But I've circled the low in 2022 and the recent high in gold. And I've also done the same on silver. And I want to read you a number. Though silver looks weak, okay? But from that low to the high, gold went up 54%, silver went up 89%. And even at the current level where gold is right now, as we do this interview, it's up 49% from that low back in September, where silver's up 56%. Yes, silver is a wild dog, but that's the way it behaves. Now, we argue that if you flip up out of here again, and I think we will, silver will be the wild dog on the other end of the leash, pulling gold up. It will be far stronger than gold. Right now, it's weaker than gold over the last month, especially. But that's the way silver behaves.
To understand the potential impact of an upcoming FED rate cut on silver prices, it's crucial to look back at history. The relationship between interest rates and silver prices has played out in dramatic ways during past economic cycles, offering valuable lessons for what might be on the horizon. One of the most striking examples comes from the early 2000s. Following the dot-com bubble burst in 2000, the FED initiated a series of aggressive rate cuts to stimulate the economy. As the FED slashed rates, the value of the US dollar weakened and silver, along with gold, began to climb. By the time the cuts were fully implemented, silver prices had surged significantly, reflecting the market's shift toward safe haven assets in response to economic uncertainty. Fast forward to the 2008 financial crisis, another critical period for silver. As the crisis unfolded, the FED once again turned to rate cuts to prevent a total economic collapse. Michael Oliver, who has been tracking these patterns closely, points out that during this time, silver prices soared as investors scrambled to protect their wealth from the collapsing financial markets. Oliver notes that the monetary metals, including silver, tend to respond strongly to FED rate cuts, especially when those cuts are made in response to severe economic distress. A more recent example occurred during the early months of 2020, when the COVID-19 pandemic sent shockwaves through the global economy. The FED responded with emergency rate cuts, bringing interest rates down to near zero levels. This move led to a rapid increase in silver prices, as investors sought refuge from the volatility of the stock market and the uncertainties of a global pandemic. Within months, silver had reached its highest price in nearly a decade, proving once again that rate cuts can serve as a powerful catalyst for the silver market. But perhaps the most relevant historical parallel to today's situation is what happened in 2010-2011. As Michael Oliver emphasizes, this period saw silver enter what he describes as an acceleration phase. After years of relatively stable prices, silver began a meteoric rise, nearly doubling in value within a few months. This was partly driven by the FED monetary policies, which included maintaining low interest rates and injecting liquidity into the markets. Oliver believes that the current setup is eerily similar to that period. With the FED potentially on the cusp of another significant rate cut, he argues that silver could be about to enter a new acceleration phase. If history is any guide, this could mean substantial gains for those positioned in the silver market before the FED makes its move. What's particularly important about these historical precedents is the speed at which silver prices have reacted to rate cuts. In each of these examples, the silver market responded quickly and decisively to the FED actions. This suggests that if the FED does decide to cut rates in the coming weeks or months, silver prices could start moving upward almost immediately. For silver investors, understanding these historical patterns provides valuable context. It highlights the potential for significant price movements and reinforces the idea that the upcoming FED decision could be a major turning point for the silver market. As Michael Oliver has consistently pointed out, those who are prepared to act swiftly may benefit the most from these market shifts.
There's something to watch because if that happens, obviously, some people will think, gosh, the metals will go down because, the market's going down. Go back to March to May of last year and the crash in banks. They went vertical. Okay. I think that next snap we get in the stock market, led by the banks probably, that's when the gold and silver will wake up because they are monetary metals. Okay. And they respond to central bank panics, monetary flows, artificially lower rates, et cetera. That's the fuel behind the monetary metals. And I think at that point, probably sooner, we'll start to see both of the metals firm back up. Now, remember gold, well, flip to the current charts, if you will, and we'll take a look at that. But look at the gold and silver below it. This is weekly action. Now, what we do here is on that chart, both charts, we circled the September low in 2022. Now, if you recall, back then in gold, it had dropped from over 2,000. And finally there you go. In late 2022, you had this washout that carried down close to 1,600. Everybody thought it was all over, going to big bear market. And we argued, no, it was a bear trap. Silver at that point in time was down to just above 17 at its low. And looked like heck. Okay. And then we surged up out of that low, and leveled off in early 2023. In fact, you'll see that spike in silver starting in March. It was about $20. It shot up over 20, 19 something, shot up over 26. That was the time of that bank collapse I talked about. Now go up to the gold chart above. You'll see how it did. It also shot up during that period, during the bank event. And then it went sideways, but firm until early this year. Now there was the surge, the acceleration phase measured by annual momentum again. We argued occurred in March. And you'll see the gold here. In fact, in price, you could see it as well. It shot up over 2,100 and bolted by April. You made a peak close in the above 2,400. That's where the little horizontal red arrow commences at that peak close in April.
As we move closer to a potential decision from the FED, speculation is reaching a fever pitch. The financial markets are abuzz with theories and predictions about what the central bank will do next, and the implications for the silver market are enormous. Currently, the market consensus, as tracked by tools like the Fed Watch tool, suggests that there's a high probability of a rate cut happening as early as the next FED meeting. The question isn't so much if the FED will cut rates, but when and by how much. Some analysts are predicting a modest 25 basis point cut, while others, including those in Michael Oliver's camp, believe the situation may warrant something more drastic, like a 50 basis point cut. Oliver, a seasoned analyst with decades of experience in tracking economic cycles, believes that the FED is facing mounting pressure from several fronts. On one hand, there's the deteriorating labor market and slowing GDP growth, which suggests that the economy is on shaky ground. On the other hand, there's the fragility of the banking sector, which Oliver has identified as a critical risk factor. According to his analysis, the banking sector is teetering on the edge, and a further decline in bank stocks could be the trigger that forces the FED to act sooner rather than later. If the FED does opt for an emergency rate cut, it would send shockwaves through the markets. For the silver market in particular, this could be the moment that ignites a significant rally. As Oliver points out, silver has been building up momentum over the past several months, and a rate cut could be the catalyst that releases this pent-up energy. The anticipation of such a move is already starting to be reflected in silver prices, which have shown signs of strengthening in recent weeks. But there's more to this story. The FED decision-making process is heavily influenced by the broader economic environment, including factors like inflation expectations and global economic trends. Recently, the U.S. dollar has shown some weakness, which is another bullish indicator for silver. As the dollar weakens, silver becomes more attractive to investors, both domestically and internationally, seeking to preserve their wealth in a stable asset. Michael Oliver's analysis suggests that the silver market is particularly sensitive to changes in the U.S. dollar's strength. If the FED cuts rates and the dollar continues to weaken, this could create a perfect storm for silver, pushing prices significantly higher in a short period. Oliver draws parallels to previous periods where similar conditions led to rapid increases in silver prices, such as in 2010-2011. Adding to the speculation is the possibility that the FED might be forced to act even before their scheduled meeting, especially if economic conditions deteriorate further. If we see more signs of trouble in the banking sector or a sudden spike in unemployment, the FED could implement an emergency rate cut to prevent a full-blown crisis. Such a move would likely catch the markets off guard, leading to a rush into safe haven assets like silver. Investors are watching closely, and many are already positioning themselves in anticipation of this potential scenario. The silver market is often a leading indicator of broader economic trends, and the recent uptick in silver prices suggests that the market is bracing for a significant event. In the end, while no one can predict with absolute certainty what the FED will do, the combination of current economic indicators and historical precedent strongly points towards a rate cut in the near future. For silver stackers, this is a moment to watch closely. The FED decision could be the catalyst that propels silver prices into a new and potentially explosive phase.
Next week.
With respect to precious metals here, you shared with me a few charts I'd like to share. And this is back in 2010 and 2011, where we saw a huge increase in silver in 2010, but then we did see a pullback, and then about $28 to almost $50 with just a few months there. So do you see a similar thing could happen now in the silver market?
We argued back in late March, based on annual momentum of silver, gold, and the gold miners at price levels that are below where we are now. Okay. That the zone of congestion that we'd been in since 2020, where we'd gone up and down in gold, basically sideways, and silver had descended in a channel, and so had the gold miners. That was over with. We're resuming the bull market that actually began in late 2015 for gold and related markets. Yes, it had a 3-year pause. That happens in major bull markets. Even this one you're looking at now, we're looking at the final 3/4 of a year of the bull market that already began in 2000 from lows in the year 2000. And so we're looking at what I call the acceleration phase at the end of a already protracted bull market. Again, our bull market, we argue, is underway since late 2015. Gold was 1,050 at that time. And we think we've entered the final several quarters of the we call the acceleration phase. Now, this is the silver price action back during that time. Back in August of 2010 and September, as silver moved up toward $20, we broke out enough long-term momentum metrics to argue that the acceleration phase was commencing. And sure enough, you had a nice move. I mean, silver went from like $17, $18 up over 30. Similar prices we have now. And then you'll notice the little red lines I've plotted under these pivotal lows on price. So if you're a price chartist, you see this ascending pattern. Well, obviously, when you broke that last red horizontal, you said, oh my gosh, we're negative zigzag. And so no doubt a lot of people were stopped out, and the market got washed out. It dropped from like $32 down to about 26. Okay. And spent a couple of weeks down there spinning underneath that last point of breakage. I've circled that level. But it looked negative if you looked at the price chart, that is. But that was a cleansing. It was the cleansing prior to the real vertical portion of the move, which was just a matter of about 3.5 months from late January of 2011 through mid-April of 2011. Silver went from $26 to $50. Boom. But before it happened, it did have that cleansing break. So we suggest that we think we're in that similar situation right now with silver.
As the possibility of an FED rate cut looms, it's essential to consider how the silver market might react. And if history and current analysis are any indicators, the response could be swift and substantial. Silver has always been a highly responsive asset when it comes to changes in monetary policy, particularly rate cuts. Michael Oliver's extensive analysis suggests that we are on the cusp of what could be a significant move in silver prices. According to Oliver, the current setup in the silver market is reminiscent of previous periods where silver experienced sharp increases following similar economic conditions and monetary policies. When the FED cuts rates, it typically leads to a weakening of the US dollar. This is a critical factor for silver, as the metal tends to have a negative correlation with the dollar. As the dollar loses value, silver becomes more attractive, not just to domestic investors, but to global markets as well. This influx of demand often leads to a rapid increase in silver prices. But there's another layer to this. Oliver emphasizes that the silver market is currently positioned in such a way that it could not only react to a rate cut, but do so in a dramatic fashion. He points out that silver has been in a consolidation phase for some time, building up what he calls latent energy. This energy, once released by a catalyst like a FED rate cut, could lead to what Oliver describes as an acceleration phase, a period where prices don't just rise, but do so quickly and steeply. We'd seen this kind of reaction before. In 2010-2011, silver prices nearly doubled within a few months, driven by similar economic forces. Oliver believes that the conditions today are strikingly similar to those seen in the lead-up to that massive rally. The silver market, often referred to as the wild dog, due to its volatility, could once again be poised for a rapid and substantial move. What's particularly interesting is the potential speed of this reaction. If the FED announces a rate cut, particularly if it's an emergency cut, the silver market could start moving almost immediately. Investors who have been on the sidelines might rush to enter the market, driving prices up in a short period. This kind of reaction is often amplified by the silver market's relatively smaller size compared to other financial markets, making it more susceptible to sharp price movements. Oliver also warns that the silver market could outpace gold during this period. While gold is often seen as the more stable of the two metals, silver's volatility means it has the potential for higher percentage gains. In previous rate cut scenarios, silver has often led the charge, with gold following behind. This could be particularly true in the current environment, where silver's industrial uses, combined with its role as a monetary metal, could see it benefit from both safe haven demand and increased industrial activity as the economy adjusts to lower rates. In short, the silver market is primed for a potentially explosive reaction to any FED rate cut. Investors should be prepared for volatility, but also for the possibility of significant gains. As Michael Oliver notes, this is not a time to be complacent. Those who are ready to act could benefit from what might be one of the most substantial silver rallies in recent history. With the silver market poised on the edge of what could be a major move, the upcoming weeks are crucial. As the FED decision draws nearer, the market will likely start to price in the expected rate cut, potentially leading to increased demand for silver and a corresponding rise in prices. The key will be to watch the signals closely and be ready to act when the moment arrives.
We came too suddenly right to those levels, and you may pause for the rest of this week. That's fine. There's justification for that, technical justification. But it looks like it was intent to come down and break those structures. And if you do, I think you'll see precipitous further price decline in the banks, this time one that the Fed will respond to, unlike back in March of last year. And I think they'll justify it. They'll have an argument to do so, and it won't be, something going on in Japan and the Japanese carry trade and all that stuff. This will be domestic. So it's something to watch. Now, by the way, I'm going to mention this because the silver and gold investors are rattled right now, especially silver investors. We'll get on that in a minute. But basically, it's our argument that the monetary metals are in opposite sync now to the stock market. Yes, recently they pulled back, but they've already been pulling back basically in momentum terms since April, May. So it's been several months of congestion for gold and silver and pullback in silver. Meanwhile, stock market only peaked last month. While they were pulling back and pausing, stock market made its high in July. It has broken enough stuff in the stock market to indicate that asset category is now shifted to a negative long-term status, which is opposite to the major trends of gold and silver. They tend to be opposite. So if you look back and say, well, if the banks are going to crash again, wouldn't silver and gold crash? Well, go back and look at what happened in March through May of last year when the banks dropped 34%. I'd see, where are my numbers here? Gold was jumped to $250 in the same time period, and silver went up $7. So it was totally beneficial to them. So I tend to expect that same response this time around in the monetary metals once the banks are triggered. So it's something to watch, especially starting.
As we approach the possibility of an FED rate cut, it's crucial for silver stackers to consider how best to position themselves. Michael Oliver has made it clear that the silver market is on the verge of a significant move, and the FED decision could be the catalyst that propels prices higher. Now is the time to think strategically about your next steps. If you're already holding silver, this might be an opportune moment to increase your holdings. Historically, silver prices tend to rise in anticipation of rate cuts, and with market expectations already building, the window to buy at current levels could be closing fast. By acting before the FED announcement, you could position yourself to benefit from the initial surge in prices. For those who haven't yet invested in silver, the urgency is even greater. The current conditions suggest that prices might not stay at these levels for long, making now a critical time to consider entering the market. Diversification within your silver portfolio can also be a smart move. Whether you're holding physical silver in the form of coins and bars or have investments in silver ETF and mining stocks, spreading your investments across different forms of silver can provide a balance of security and potential for growth. Michael Oliver has highlighted the potential benefits for silver miners in particular, as lower interest rates make borrowing cheaper, potentially boosting profitability in the sector. This could translate into significant gains to those holding mining stocks. Keeping a close eye on the US dollar and global markets will also be essential. A weakening dollar, which is likely in the event of a rate cut, tends to boost silver's appeal internationally. This could lead to increased demand from global investors, further driving up prices. Staying informed about these broader economic trends can help you make more informed decisions about when to buy or sell. It's important to stay nimble and ready to adjust your strategy as the market evolves. The silver market is known for its volatility, especially during times of economic uncertainty. While the potential for significant gains is real, sharp price swings can also occur. Michael Oliver advises maintaining flexibility. Be prepared to take profits if prices spike quickly or to hold steady through short-term dips, depending on how the market unfolds. Finally, while the immediate focus is on the potential short-term, gains from a FED rate cut don't lose sight of the long-term outlook for silver. Oliver's analysis suggests that we may be at the beginning of a prolonged bull market for silver, driven by ongoing global economic dynamics. Holding onto your silver investments for the long term could yield substantial returns, especially if the trends that are driving the current market continue to play out. In summary, the potential for a FED rate cut presents a unique opportunity for silver stackers. By strategically positioning yourself now, whether by increasing your holdings, diversifying your portfolio, or staying informed, you could be well placed to capitalize on the surge in silver prices that may follow. The key is to be proactive, to prepare before the market moves, and to remain adaptable as the situation develops. Those who are ready and informed stand to gain the most from the opportunities ahead. Oliver also warns that the silver market could outpace gold during this period. While gold is often seen as the more stable of the two metals, silver's volatility means it has the potential for higher percentage gains. In previous rate cut scenarios, silver has often led the charge, with gold following behind. This could be particularly true in the current environment, where silver's industrial uses, combined with its role as a monetary metal, could see it benefit from both safe haven demand and increased industrial activity as the economy adjusts to lower rates. In short, the silver market is primed for a potentially explosive reaction to any FED rate cut. Investors should be prepared for volatility, but also for the possibility of significant gains. As Michael Oliver notes, this is not a time to be complacent. Those who are ready to act could benefit from what might be one of the most substantial silver rallies in recent history. With the silver market poised on the edge of what could be a major move, the upcoming weeks are crucial. As the FED decision draws nearer, the market will likely start to price in the expected rate cut, potentially leading to increased demand for silver and a corresponding rise in prices. The key will be to watch the signals closely and be ready to act when the moment arrives.
Just so much data points, but I'm sure data points would be affected. I mean, if you're running a company and you have economic data points that are coming down, and you're not an economist, but you run your company, and you're either going to hire new workers or lay some off or not hire anymore or cut your production capability or not build a new factory, et cetera. All these variables outside that we're talking about, like, political uncertainty, data points that are getting worse, will cause you to have an economic consequence down the road if these things started to happen. So yeah, it could be. But I think the main thing is the emotional impact on voters who, when they're in the stock market, you don't want to have some dark cloud out there that is uncertain in terms of its wave effects. What do you want to do? Well, you want to stay speculatively long, or do you want to lighten up your portfolio and go to cash or go to bullion? And this is a variable I think that would assist the monetary metals again, because as you enter a period of uncertainty, this is also a factor that would impact the Fed decision. Oh no, they don't talk about politics. They swear that's true. Okay, but uncertainty caused by politics and its impact on economic data points, they'll be fully aware of that. And so if the Fed starts panicking because the bank sector starts to break in the next week or so, that's just the beginning. Sentiment can go from light to dark overnight, and suddenly, if you have a fear factor, what are you going to buy? And I suggest to people that they stand back and yeah, silver's weaker than gold now, yeah, and we think that's caused by the stock market break recently. Well, we argue not. We think it's just the silver behaves like a wild dog. But look at the other variables out there that if they engage and you want a sense of certainty in your life, what do most people want to get into? Well, look at the portfolio action of like Newmont Mining. Stanley Druckenmiller back in mid-February probably laughed by other asset managers when it had bought a ton of Newmont Mining, and dumped a bunch of big name tech stocks. But it was a little early. The market didn't top out then. It was March, or February, March. Market didn't peak till last month. So he probably missed something on the tech stocks. But he bought Newmont Mining around $32. Right now on a dip, it's at 47. How come it's doing so well? If the stock market's starting to wobble, how come Newmont's hanging around its recent high, which is dramatically off its February, March low? It's a blue chip, the big blue chip. How come gold's hanging around quietly, 1% off its all-time high weekly close? Somebody's buying it. So, and I think part of the reason for that is not just foreign governments we know are buying gold, but I think there's a rise in domestic consumption of that too, where there's a sense of uncertainty, and asset managers here are looking for something that isn't going down. And if you start to break the stock market more and more of them will start to look for something that isn't going down. Doesn't have to be going up, just look steady. And T-bonds are one of those that we called recently. Sharp upside there, dropping yields on the long dated end of that market. And the monetary metals, I think, are hanging in tough, except silver's the wild dog, of course. But I think that as these events start to unfold, that's where money's going to go. And so it's hard to calculate what that political variable is. But it's got to be, I think it'll be net positive for gold and net negative for.
As we draw closer to a pivotal moment in economic policy, it's becoming increasingly clear that the FED next move could set the stage for a dramatic shift in the silver market. The possibility of an emergency rate cut isn't just a financial footnote. It's a potential game changer for anyone invested in precious metals, particularly silver. Michael Oliver's insights have been instrumental in understanding the magnitude of what might be about to happen. His analysis points to a market on the brink of an acceleration phase, where silver prices could not just rise, but explode in a way that mirrors past surges we've seen during similar economic conditions. The combination of a weakening dollar, global economic uncertainty, and the FED likely intervention could create the perfect storm for silver to rally in a way that few other assets can. If the FED does cut rates, especially an emergency move, we're likely to see a swift and powerful reaction in the silver market. History has shown that when the FED takes such actions, silver prices often surge, driven by increased demand from investors seeking a safe haven in times of uncertainty. This time, with the added pressures of a shaky labor market, slowing GDP growth and potential instability in the banking sector, the conditions are right for silver to shine brighter than ever. For those who have prepared, who have positioned themselves ahead of this potential surge, the rewards could be significant. But this isn't just about short-term gains. The broader economic context suggests that silver could continue to perform well in the long term, especially if the global economy remains volatile and central banks continue to struggle with inflation and growth challenges. Now is the time to act. If you've been considering increasing your silver holdings, diversifying your portfolio, or even just staying informed about the market, The coming weeks could prove to be crucial. The FED decision will likely be the trigger that sets everything in motion, and once it happens, the silver market could move quickly. But remember, while the potential upside is substantial, it's also important to approach this with a clear strategy. The market will likely be volatile and sharp price swings could occur. Staying informed, remaining flexible, and being ready to adapt to changing conditions will be key to navigating this period successfully. In conclusion, the FED possible rate cut represents a critical moment for silver stackers. This is not just another economic event. It's a potential tipping point that could propel silver prices to new heights. As Michael Oliver and other experts have indicated, those who are prepared stand to benefit the most. So, whether you're a seasoned investor or new to the silver market, now is the time to prepare, to act, and to position yourself for what could be one of the most significant silver booms in recent history. And with that, I encourage you to stay engaged, stay informed, and make sure you're ready for the opportunities that lie ahead. Remember, while we can analyze trends and make predictions, the final decision is always yours. This is not financial advice, but a strategic perspective on what might unfold. So prepare wisely and be ready to seize the moment when it arrives. And if you found value in this discussion, don't forget to subscribe to our channel for more insights and analysis on the silver market and beyond. Together, we can navigate these uncertain times and make the most of the opportunities they present.